you can do what you want with the equity in your house. If you want to, like I've had people do cash out refis to go buy rental property.
Right.
So they'll say, hey, you know what? I've got a bunch of equity in this house because I live here and I inherited it from family.
Mm-hmm.
It's paid off. They can do a cash out refinance on this property that's paid off.
Mm-hmm.
And then they're a cash buyer to go buy investment properties.
So how does the cash out work?
So
let's get into more depth of it.
Yeah, so it's a refinance. Whenever you add the cash out feature, the loan interest rate's going to be a little bit higher.
Okay.
A normal rate term refi, which means you're just refinancing to get a better rate or a more favorable term, so 30-year to 20-year, those interest rates are going to be a little better.
Okay.
Comparatively to cash out.
Okay.
If it's cash out, interest rate, going back to before, it's based on risk. So if we're increasing what you owe on this single property, it's a little more risky.
Right.
So the rate's a little higher.
Gotcha. So how it works is that you're going to say you have 200 in equity in a house, 200K, and then you want to do a cash out refi, you could pull out, say, 50K for another down payment on another place.
Yep.
But then you'd only have 150 in equity, so then your loan for that original property would get bigger.
A little, yep. So the payment's going to be higher, so you've got to factor that in as well because your payment's based on how much money you owe. So if you increase what you owe, payment's going to go up too.
Gotcha.
So when people are thinking about they want to be a cash buyer on their next investment property, I like to bring up the idea that property might cash flow on the numbers you're factoring in, but also factor in the extra cost and risk you've put on your primary residence.
Right.
Because that 50 grand came from somewhere, and it came from leveraging where you sleep at night.
Right.
So
interesting.
So you've got to I can make $300 a month if I buy this rental property. It's like, okay, well, you increased your payment here by $250 a month.
Mm-hmm.
So you're really only netting $50 a month. Now you've got other tax reasons why that would make sense, but you got to look at the big picture.
Okay. So would that the cash out refinance would completely change the loan on the first house?
Correct. Yep. So then, so then you would owe $250 on your first mortgage. And then if we're looking at putting that on a 30-year, or maybe it might be more advantageous to do a 20-year loan, now you're really stepping up your monthly payment because not only are you shortening the term by 10 years, but you're also increasing what you're paying back.
Interesting. So a lot of people use it for investment properties, but you could use the cash for
You can
anything.
use it for whatever, man. You can go on a trip to Spain. You can buy your dream car. You can do whatever you want.
So it's a way to put some money in your bank account quick.
Correct.
Gotcha.
Comes at a cost.
Right. Yeah, it comes at a cost. Yeah, I didn't think of that it would renegotiate the whole terms of the first mortgage.
Yep. It's a whole new loan, a whole new process. Whenever you refinance, we still have to pull your credit. We still got to get 2 years of taxes. We need recent pay stubs for you, W-2s, bank statements, picture of your ID, the whole litany of checklist that we need for documentation. It's a full mortgage process.
Yeah.
So yeah, it's a new loan. It could be a new lender, it could be new interest rate, new term.
Okay.
But yeah, you're resetting the time frame.